Welcome back from lunch. This is now we're going to have a fireside chat with Ray Rothrock, chairman of the National Venture Capital Association and partner at Venrock Ventures, with Chris O'Brien from the San Jose Mercury News, and followed at about 1:15 when we'll start the company presentation. So, Chris and Ray, over to you.
Do we have are we live?
You guys
okay,
can hear us?
Great.
Great. Well, thanks. It's our job to wake you up from your post-lunch stupor here. And I'm sorry because I didn't quite hear Chris mention this, but of course, the other notable thing about Ray is that he's just starting his year as chairman of the NVCA. So this is good timing, and as you all know, there's been some notable IPO news of late, which was still on the radar, I think, when they asked us to do this way back many months ago. So the timing is sort of interesting there. But before we jump into that, I just want to sort of start it off with a sort of broad question, which is just to kind of ask you, looking at the year ahead in your chairmanship, what are kind of the top things on your agenda as you look over the next year?
There are a number of things on our agenda, Chris, that really matter. Good news, bad news, it is an election year. And they say not much happens in Washington in the summer as everyone goes home to get reelected. But already we've had a number of significant pieces of legislation brought up. Cybersecurity is now front and center. The U.S., several Senate committees have made trips out to the West Coast. They seem to be believing that we might be able to make something out here that they could use, which is positive. The other is immigration, which just this morning I got a piece of email with some new legislation that was introduced today. They're going to have a big talk in next week. As you know, immigration is a really hot issue in the startup world. I haven't seen a summary yet, so I can't really comment about it, but the NVCA has been on this point for a long time. But it's one of those issues. It's the third rail in Washington, and it's not so much about, the PhDs who go back home, they always say, but it's about the other 10 million people who are here illegally that gets Congress all weed up and messed up. So those two things seem to be percolating now. From an agenda point of view, part of the NVCA's job is to protect entrepreneurship and make sure that it stays healthy and vibrant. And in my 5 years on the board of the NVCA, I spent a lot of time sort of defending the existing ecosystem, such as it is, because it seems to work pretty well. And the Jobs Act is sort of the first time we've actually been on the offensive and added to the ecosystem we thought was there. But with the election possibly of a new president and new Congress, either side, taxes are going to be front and center with the expiration of the Bush tax cuts, which the lame duck session will have to deal with one way or another. And so anytime you mention tax, Congress goes after investors. They think there's a lot of hidden money there.
Yeah, and I mean, I would be shocked if something happens on the so-called human capital immigration issue in an election year. I was talking to someone at TechNet, and they said that's the number one thing they hear when they talk to people in the Valley. But you have to believe that's a tough one to crack, in the next 6 to 8 months. But you mentioned the Jobs Act. I mean, a lot of people initially were surprised that got through, and in a relatively, in this day and age, I think in a relative bipartisan, manner, which is downright shocking, given the last 2 decades of politics in this country. Now, I had written, and you mentioned that you had read this, a couple pieces fairly critical about the need for that legislation. Concerns about some of the rollbacks in transparency, some of the definitions of the on-ramp being a bit too large. But I wonder if you can just sort of start out on a high level and sort of explain to me why I'm wrong. Why did we need this, and why do you guys continue to support this? Sure.
So, in venture capital or even entrepreneurship, you start a company, and at some point you need some liquidity. You need to exit. Your investors would like a return on their investment. You would like a return on your time. And so as that had increased, essentially after the bubble in 2001, the average holding period for a venture capital investment from the first dollar in to the exit was 4 or 5 years. When I joined in the business in the late 80s, it was about 4 or 5 years. It got a little shorter at the end of the 90s, but it was 4 or 5 years. And so the system had sort of completely worked around that zone. In the 2000 decade, it extended to 9, 10, 11 years. We still have some portfolio companies that are even 13 years old. They're doing quite nicely, but they're just not there yet. So the problem with that extended holding period is that it continues to tie up capital. The early stage investors, which is most of the venture community, has to continue to put in capital, which they would normally be using for other startups. So when you have this long cycle time of tying capital up, you essentially slow down the whole ecosystem. So if you can make it 4 or 5 years, if you can somehow roll back that holding period, you free up more capital. And the flow of capital is what makes all this work. All the good ideas can get invested on, the LPs can get paid, they can be happy and provide more capital to the GPs to do more investments. So as it gets longer, it slows down and it's just friction. So that's the big picture. We started talking about this in 04 and 05 in Washington, meeting with whomever would listen to us. In fact, just as a sidebar, we met with the Fed and Chairman Bernanke and his crew there on our first visit, and we made a presentation. And Chairman Bernanke was very funny. He said, so let me get this right. How many venture capitalists are there in the United States? And Dixon Dahl said, well, I think there are about 4,000. He says, you know, that's not very many votes. Good luck with this. So, but we continued to collect the data, and a number of academics stepped in and actually showed where the Spitzer decree, the Sarbanes-Oxley had increased the cost, and all these other factors were coming in that was making the holding period longer. And we made the case, and as you know, Kate Mitchell on her watch started this whole process with the U.S. Treasury, and Secretary Geithner picked it up, and a whole lot of momentum got around the IPO on-ramp. Well, there were other things brewing in Congress at the same time. The crowdfunding was one of them. And it was from different corners of the Congress. And so what happened was they all got together, built this big bill, amalgamation of all these ideas about how to create more activity, entrepreneurial activity, increasing the shareholder numbers and all that. It all got packaged up, so everybody got satisfied. And that's what sort of triggered the run. Yeah. And it was only about 45 days from that moment until the president signed it. So, I mean, it's light speed as Congress goes. But it was all the constituents having something in the story, I think, is what made it go.
Now, you know, among my concerns, you know, one of the things, and if folks here haven't seen this, you all, a couple of years ago, I think when Dixon was the chair,
right,
in your role, came out with what I thought was a great report, sort of analyzing all these things we're talking about in terms of the what was affecting the IPO market at the time. I think I want to say it was like 2009 or 2010, and I think they broke it into 4 pillars.
Right.
And so I had a lot of respect for the sort of context they put around this, which is to say, okay, the regulatory stuff is an issue for sure in our view, but it's one of several.
It's just a cost, which isn't an issue, but
right.
it's a cost.
But they said, you know, they also pointed to the disappearance of the boutique banks.
They'd already sold themselves off in the late 90s.
And the cost of some of the ancillary services, legal, accounting, things like that. And there's a 4th one now I'm forgetting.
Separation of research from the banking.
Right.
That's the Spitzer decree.
And so, and we see that with a lot of companies that are still public, but are sort of in this, I don't know, a pit of despair, and they're public, but no one covers them, and that's a tricky situation. But so it still seems like, you know, assuming you've dealt with that one pillar, you've got these sort of challenges on the other 3 fronts. Now, is there anything to be done in those other areas, or is that just something you have to sort of wait and see what the market does?
Well, they're going to have to wait and see on a couple. One of them, nothing will be done, although it's being discussed in Washington now, is the whole decimalization. That actually occurred in the 97, 98 time frame. It's just impact of the cost and the size of the IPOs were such that decimalized trading did not make it profitable for the banks, which is why the IPOs, there was this sort of no man's land between the very tiny and the very big, and a lot of the boutiques couldn't make money, and so they had to migrate to some other thing. I don't know if that'll ever come back. I don't know if they'll ever fix that. The research, I think that system has sorted itself out nicely. I had an IPO last October, a $100 million software company went out at $600 million, and the research has been very nice. So at least from my standpoint, that was my 7th IPO in my career. It seems to be working fine. So I think the system has sorted that out for the smallish IPOs, which is really key. The economics, that's always going to be an issue. Banks are banks.
Right. So now this thing passed. I think the other sort of challenging issue for me was sort of defining the exemption as the $100 billion mark.
$1 billion.
$1 billion. Sorry. 1 billion mark, but I think that accounts for, according to Renaissance, something like 90% of the IPOs we'd seen in the past decade or so. So it seemed high. It seemed like, you know, for sure, if you're going to make the case that these costs are a proportional burden, the $100 million, the $200 million companies, okay, you can sort of see that challenge. You know, if you get to a company that Groupon was over that threshold last year, I think, so they wouldn't have been exempted, but they were sort of close to that 1 billion mark. But it struck me as high. I mean, why did it need to be that level?
Well, why did it need? The data supported that if you can get out around 100 million, that if you're a fast-growing company, you'll be at $1 billion within 4 or 5 years, if all things are good for you. So the idea, it wasn't that it made less transparent the activity, but it did things like, for example, instead of having 3 years of fully audited financials, you only have to have 2. The 404 implementation, the internal auditing and all that, it gives you time to ramp that on. So those costs, which can be very high in the beginning, are now sort of ramped in. So as a percent of revenues, the idea is that it will be roughly the same throughout that period, and when you get to be $1 billion, well, then you're fully implemented, and the cost of maintaining your public status and such remains about the same. It was really a numbers game. But they had to pick a number. 500 million was probably not suitable, and 100 billion or 10 billion would have been laughable. Yeah, probably. So
that passed, and it seemed the start of this year seemed from where your world sat seemed pretty rosy. We had a record number of IPOs in the pipeline, I think, beginning of the calendar year. Pretty strong start to the IPO market the first couple months. You know, several big ones here in the Bay Area. And of course, then we had Facebook. And we're all familiar with that story, so we don't need to rehash it at the moment. But, you know, now a lot of the question is, you know, what is the fallout, or is there fallout from the Facebook? I'm curious, from the Facebook IPO, I'm curious what your thoughts are and what you're hearing now from members.
Yeah, well, the Facebook IPO was, of course, from any investor in Facebook's point of view and in the company's point of view, extraordinarily successful. They raised the money they were after, they raised it at the valuation they were after, and you know, back in the day, actually before I was in venture capital at Sun Microsystems, I remember when we went public, I think the stock went up a quarter the day it went out. The company captured all the value. But somewhere along the way in the 90s, we got into this mode of it's got to pop to be called successful and all that sort of stuff. But, you know, I got to tell you, I had a bunch of those where it popped. And you sit there and you say, that should have been our money. That money should have been in the company. So from a company, from a venture capital investor and the entrepreneur's investor's point of view, I think it was a highly successful IPO. You know, why it's down, obviously there's some people thought they were going to make money and they've just abandoned it and sold the stock, which puts more stock in the market and drives the price down. I think there's some of that. Plus, you know, the whole, the macroeconomic view of the world right now is pretty gloom and doom. So you might say Facebook not only priced out perfectly in the market, but they also hit the macro in a downtrend, which I think is driving it down. But, you know, I think Facebook, having raised $16 billion, there's not many balance sheets like that in tech these days. So they are in a prime position to really probably juice up the ecosystem some. They will undoubtedly acquire more things. They will make investments. They will use that money to develop their business further. So I actually think it's pretty good. The members that I've talked to, and believe you me, I've talked to a lot of them, or they've talked to me in the course. You know, it's okay. It's good. Like I say, our view is the company did what it needed to do. The unfortunate thing is it makes buyers a little nervous because they could buy and be stuck holding them. But, you know, the truth is most tech IPOs go underwater within a year of their, I mean, most of them do. And then most of them recover maybe a few years later. Some of them don't always. That's not a guarantee. But the truth is these things are priced very much at the top of the market. You know, it's just like when you sell a stock or you give a stock away to charity. You're trying to time it at a maximum point of view. And so it is what it is. And if the market drives it further, that's great. If it doesn't, well, you know, and you're holding it, you should either decide to hold it for the long haul if you're bullish on the company, which would be the hope of any CEO and any entrepreneurial deal I've ever been in, or get out of it. And I think a lot of people are getting out.
So there's a financial aspect, and I agree with you completely. I mean, if I'm at Facebook, by the numbers, it was a hugely successful event. I mean, they're primed for years now, I think. You know, on a personal level, the folks who sold, their overall, you know, they'll have some tax issues or whatever, but they'll be fine. They made out great returns on their personal investments. The other thing I think about is, again, that sort of more psychological aspect, that issue of trust, and how Wall Street sees Silicon Valley, which has always been sort of a complicated relationship. I felt one of the things that hit us out here after the .com bust was, as much as the financial aspect, that trust issue. How much fundamentally, investors and funds believed in the tech story as a financial growth story, and so I wonder about that aspect of it in terms of these other companies coming along, trying to tell them, sell their story and say, we're here, but we've got this growth, and we think this is, is there going to be a trust issue, and is that something that tech is now going to have to overcome?
Well, trust. I don't know that if there is some mistrust or concern, I don't know that it's with the company per se, or the early investors in the company. I might offer this up related to that, because Rich Colgard published a really interesting article the day after the Facebook IPO. I don't know if you saw it. Mm-hmm. It was really good. He said, when Microsoft went public, if you'd have bought a share that day and held it to now, you would have made 900 times your money. If the day Google went public, you'd bought a share and held it today, you would have made 10 times your money. The problem with the Facebook price is that if you buy a share, you got to wait till it's worth what? $10 trillion? Yeah. Well, there's not very many trillion-dollar companies, so the probability of it going up was always diminishing. But Rich's point was, look, if you're a consumer of this stuff, and you can go out and buy a share, then it's kind of a synergistic relationship. You're a user of the product, you own the company, and that's a very positive thing in tech, because tech is very much I don't want to say mythological, but it's cult-oriented to some degree, and people really fall in love with that, and that's a very important dimension of the big successful tech companies. Every one of them. It doesn't matter which one you refer to. So I think that's missing here, and maybe that trust is broken. I don't know, but I think Rich made a very good point about that relationship.
By the way, I'll acknowledge it's sort of weird to be thinking about us worrying about banks trusting us.
Yeah, right.
Banks, of course, have their own trust issues in the last
4 years.
Decades. But then in terms of venture exits, which is it's always good to keep in perspective at the end of the day, and I think this was certainly even true during the .com bubble. I mean, the vast majority of exits are going to be acquisitions, and so as you noted, Facebook now has a huge war chest in that front. But then I also wonder, is there overall concern about things like valuations coming out of this? People maybe holding on to their money a little bit to wait, maybe it's a quarter or two, just while they all sort of look around and see, well, what is the fallout? And, does this mean the exit market has changed, or IPOs are closed, or is there any sort of pause going on?
There is a pause going on. I can speak firsthand about that. A number of our deals were in the market raising capital, and at pretty nice prices, in fact, relative to where they would be in other times. And those deals have all come to a pretty much screeching halt because of this. In the public market, there's a metric that's calculated. It's called the VIX, V-I-X. And it's a volatility index, and it's way off the charts right now. Back in Q1 and Q4 last year, it was nice and smooth and steady. Yep. And we got a couple of deals out, Vocera and Imperva, in those era. Right now, it's really crazy. And a lot of people that do late-stage investing look hard at that index and try to predict how it's going. So that, coupled with, $100 billion was too much, maybe, what the market thought. It's cooled off, so everyone's sort of cooling down. I don't know if it's going to slow the pace, but I think it's going to impact valuations for sure, which isn't always a bad thing.
Yeah. The other thing that is sort of different this time around, or certainly it has a bigger impact, is secondary markets, which were, if they were around at all 10 years ago, I don't remember hearing much about them. Yeah. But they've become a much bigger force. And so there was some talk even that Facebook felt a little boxed in, and that, I think the last secondary trades were supposedly like 40, in the mid-40s somewhere, so they felt some pressure to, get the stock closer to that, or maybe they didn't. But now that they've been around for a few years, is there any sort of consensus in the venture capital community about their worth or their value to the entire system? I mean,
of the secondary buyers and the process?
Yeah.
I'd say the consensus, not uniformly, but a consensus would be that it's a positive thing. If the final exit is going to be a 10-year cycle, relieving that pressure of a little liquidity along the way for a founder that has a big position and has a new family. A lot of founders get married while they're founding their company, and then they have children, and they're still tied up with all this. Their whole net worth is tied up in this stock that they hold, which they can't do anything with. So those things are relieving a lot of pressure, and in fact, we have sought that out for a number of our companies when we sort of sense the pressure and stuff. So it's a good thing. If you look at the data that these secondary market, they haven't done that many transactions, and in not very many companies. Mostly in the hot internet consumer plays and stuff. You know, I doubt the chip companies have had much liquidity in that area. But it's an important thing, and it's not bad. And you know, I think like any situation, it's always good as long as the valuation keeps creeping up. But those secondary sales, if it creeps down, I think the buyers on the way up are going to be pretty upset. We'll see.
Right. By the way, I think we're going to have some time for questions and answers. I don't know if we have a microphone or how we wanted to do that. But if you've got a question for Ray, go ahead and raise your hand.
Just jump up.
Yeah.
What do you think about the Paul Graham email that was sent out?
I just heard about it just now. Well, there's never been a shortage of capital for good ideas. Never. It ebbs and flows. The industry is running at about $20 billion, $25 billion a year right now. There were a lot of angels created a couple of weeks ago, Facebook. I think, I don't know exactly what he means by there's going to be a shortage or a contraction, but I think it's just going to, as you were referring to, Chris, that people are going to think twice. They're going to maybe scrub the valuation a little harder, look at the deal. But I think there's plenty of capital out there.
By the way, I don't know if everyone...
Oh, sure.
It was just out, but just in brief summary, it sort of goes back to what I was asking Ray about before. In very brief summary, just sort of said he was telling the Y Combinator alumni and current portfolio companies that expect that there could be a sort of cooling down of funding, expect lower valuations in the wake of the Facebook IPO, and just be prepared for a big reality check the next few months, which was sort of being compared to the sort of famous Sequoia letter that went out back in 2007 or 2008 that, we're all doomed, hold on. And of course, that was
Look at the
true,
result,
but not because of, venture and tech in particular.
Yeah, I don't think it slowed Sequoia down one bit from that letter.
Sure.
But, I think maybe what will occur, and this does happen when you get a little nervous, is you do a gut check, you do a second, you do that final due diligence, you relook at that exemptions list before you go in, and you recheck with the CEO to make sure there's no material changes or whatever market changes. But I don't think it'll affect it.
Yes. Yes, over here.
Quick question. Could you stand up, please? It feels like there's a lot of funding for smaller companies that build apps that are relatively cheap to build, obviously, because there's so many angels. And there's a lot of money for companies that decide to raise a ton of millions of dollars instead of going IPO or before going IPO, like, the big companies like Twitter and so on. And not so much money for companies that are actually building a technology and could become a billion-dollar company, but need maybe $3 million to launch. And I just wonder, what do you think about it, and what do you think is the best strategy for those companies?
Yeah, I really feel you have something.
I was going to say, can people hear the question?
Oh. So the question is, what happens to those companies that just need $3 or $4 million that are kind of in the middle of the stack, a technology company that isn't a small angel finance deal, maybe consumer internet, and isn't a multi-billion-dollar financing like a Twitter or those kinds of guys? So what do you do with those companies? Because there are a lot of them out there. And my answer is I feel your pain greatly because I'm a technology investor, not so much a consumer investor. So I have a bunch of those companies. The pressure that we as GPs get is from the LPs. And the decade of the 2000s was awful. Let me say that. It was awful. And the LPs are pretty ripped about it. I don't blame them. I'm an LP in our fund and a bunch of other funds, and yeah, it's been tough. So they've put a lot of pressure on us to create more liquidity, get the flow going again. You know, it's all about shrinking that cycle time for that flow. Some of these tech companies, you know, bring into this security technology company I took public last year, $100 million in revenue. It should have been public 3 years earlier in a normal age. And so life would have been good. No one would have complained. There are investors out there that do those kinds of deals. You may have to look a little further for them. You may have to really work that network hard. But there are still, I believe, I have had no trouble syndicating deals with other people who want to do those $3 to $5 million deals. They're more syndicated. They're less likely to be single shots. But they're there. But I mean, you got to paint a vision, right? You got to. It's got to be a very convincing vision that you're going to be $1 billion or worth $1 billion, and here are the comps. So you got to do your exit homework to make sure you can get their attention. That was a good question. Yes.
Just to follow up on the question we asked earlier, can you talk about the role of strategic investors, both in investing in roles like this and also providing exits as part of the IPO round? How's it compare now versus past cycles?
Yeah, so this is about strategic investors, meaning corporations primarily. I've seen it 3 times in the last 25 years where corporations sort of roll into the market, provide a bunch of capital. Some VCs think it's sort of dumb capital. It's hardly dumb capital. The risk for the startup company, if it's too early, is that you may get a different corporate member sort of ebbing and flowing, coming into the board meetings and such. But in the current state, and there is a huge rush right now, the MVCA, we've got like 60 corporate members, never had that many in anybody's memory. Is that there's a lot of good technology. There's a lot of small companies that are really products or features that they can see integrating into their product line. So they're sort of reaching down deeper into that network and pulling those guys in. You know, you got to be real careful when you do those, because if they have an option, a right of first refusal or something, you can get in a lot of trouble on your exit. So to the extent that you can make them look like a venture capitalist or just a financial investor, the better off it is while you develop that business relationship. But it is a big deal. And the last 2 deals I've done, both had a corporate strategic investor, not by our choice, but they really sort of pushed their way in and convinced us they could help. So we took them.
All right. Well, I think
is that it?
That's it. Yeah, we're out of time. So
okay.
I want to thank you for
Thanks, Chris.
taking the time.
Yeah,
you
bet.
Everyone.
You bet. It's good.
Thank you both very much.
Chris. You bet. You bet.
Terrific.
All right.
Thank you both. If we can take your microphones.
Nobody's asleep.
So what we're doing now is we're now breaking into 2 camps. This is the time when the 30 startup companies now have the opportunity to start their pitching. In this auditorium, we have the first session of Next Generation Internet, and in Saturn Auditorium, we have Life Sciences. So if anybody wants to see the Life Sciences pitches, you have to move into the Saturn Auditorium. If you're here to see Next Generation Internet, this is the place.
Ladies and gentlemen, those of you who are staying here, if